Welcome, everyone. Welcome to the Trade Findings and Adjustments for Thursday morning, the 18th, I believe, of 2021. My name is Kevin Hurley, and I'm going to finish our exponential growth. Part 3 of exponential growth involves booking a profit on stock ownership and converting the profits or a portion of those profits into a stock replacement strategy that leverages the returns. And that's kind of the key. How do you convert profits that you get called away on a stock or that you sell on a stock to still be in that stock and leverage the returns going forward? I took a picture of Disney. There's a bunch of you that might see this in your accounts coming up here. For this particular individual, the cost basis of Disney is 111. He has the right to sell Disney at 187. I'm going just to do the simple math to give you the net gain in selling Disney. We have the right to sell it at 187.50 between now and the third Friday in February, which is tomorrow. You have to take out your cost basis of $111.97. You have to also add in the cost of the put, which is $6.60. We might get back a portion of that. We might sell it off for $3.35, which would be a credit into it. Subtract the cost basis, but right now we could get a credit back in of $3.35. So if I was to sell this today, I would take my calculator and I would get in my calculator and I would say, okay, we can sell at 187.50. I have to subtract out the $111.97. That gives me $75.53 a profit. I have to take out of there the $6.60 for the cost of the put, but if I was to sell it, I would get back $3.35. My net profit would be a $72.28 profit on Disney. Kevin, why would you do this now? Why would you do it today? Well, I don't have to do it today, but the idea behind this is I want to sell it sometime now, right? In some way, shape, or form, I want to sell it now so that we get our taxes this year instead of next year. Next year, taxes will probably be higher. We've got the Democrats that are holding the executive, the House, and the Senate. When you have all three bodies, a lot of things get pushed through. Higher taxes will most likely be on the agenda of the Democrats so that they have more money to spend. It's kind of the way it goes on the Democratic side. So expectations are higher taxes next year. You want to sell this off this year so that you don't lose, so you don't pay up to 40% more taxes. 33%. They might take long-term capital gains and move it from 15 to 20. There's a lot of what ifs in there. But the constant is probably going to pay more taxes, so we take our profits now. I'm just going to write overall profit is equal to $72.28 times the 600 shares, a profit of $43,368 overall. It will free up in this account, but it will free up $113,000 in this account. But it's the profit we're focusing on. How do we leverage this $43,000 through a stock replacement strategy that will still keep us in the position? Now, as you've been taught before, at least through Hurley Investments, through Keeve and myself, right? That stock replacement strategy is the long call. And Jim, I know I just sent you some information, so someone tell me, what is the long call, right? what is this long call option? As you're typing, you should say, Kevin, it's the right to buy a stock at a certain price for a certain period of time. Why do we use that leap long call? And that's an interesting question, but the short answer is we use a leap long call to leverage profits and to mitigate or lower risk. Kevin, what do you mean by mitigating risk? Well, let's look at what type of leap long call we might use. Right now, shares of Disney are at $183.18. That is your risk if you purchase the stock of Disney. You could lose $183.18. Probably won't happen. Disney's not looking like they're going to go out of business, but that is your risk. If you want to define risk as what's realistic, well, Disney could definitely lose half its value. It probably has, what, $91.50 of risk in it. No doubt Disney could go back down to $90. That actually would be $93.25 of risk in it at this exact moment. Kevin, how are you going to lower that risk? Explain to me this leap call thing. So as we look to our strike prices, our amount of time, we got to April 2021, 57 days of expiration, May, June, July, October of 2021 is 239 days. January 2022 gives us 337 days, or January 2023 gives us 701 days of expiration. We're buying a position that can be in effect, meaning we have the right to buy the stock for 701 days. If I was to pick a strike price, I've got two choices. I can pick the $180 one, right where it's at in the money, and I can spend $39. Or I can go out in time and I can spend $31 and use the 200. There are pros and cons to each one. If I was to use the 180 at the money strike price, the best bang for the buck, I'll make 62 cents on every dollar that Disney makes. If I use the 200, I'll only make 54.5 cents. So my question is, am I going to buy it for where it last changed at $38.37, or do I want to only spend $30.60? It's a question. It's a question you have to ask. Kevin, what is your premise based on? Well, Disney. Disney's going to have cruise lines opening up. It's going to have movies that are coming out. It's going to open up California and possibly get back in the next year to a full capacity of its theme parks. It's going to pass 100 million subscribers to their streaming online movie catalog. And let's face it, Disney Plus is by far the best babysitter for your little kids, for your teenagers, and for yourself if you like ESPN Plus. I think the sky is the limit. In fact, I think Disney in the next 2 years could get up to $300 a share. Do I spend $40 and have a break even at roughly $220? Do I spend $30 and have a break even at $230? I would probably choose to be cheap right now. Cheap because I think I'm going to have the dollar cost average. Cheap because I think once we get our stimulus, the bottom's going to fall out a little bit because the numbers don't add up for how far our market is going up or the fact that it's even going up in the first place. There are too many indicators requiring a pullback, not just a 10%. I'm going to show you that one next week, by the way, on a commentary, but really a bear market, a 20% pullback plus. I want to go cheap. I would choose the $200 January 23 leap long call position that will cost me $30.60. How would I do that, or how would I start that? Well, I'm going to buy to open the January 23 $200 strike leap long call for $30.60 per share. I'm going to sell this off for basically $113,000. I have $43,000 of profit to work with, meaning I'm keeping the original nest egg safe. I'm now playing with the house's money. If I was going to do this position, I'm going to buy 5 contracts. Kevin, why did you decide 5 contracts? You had 600 shares. Well, I'm going to buy 5 contracts because I like how the numbers work out. Meaning 5 contracts is equal to 500 shares, right? Each contract's worth 100 shares times $30.60. I'm now going to have the right to control 500 shares, $30.60 times 500. It's going to cost me $15,300. We were talking about mitigating risk. My shares right now, but realistically, I have $110,000 here. We decided it could lose half its value. I've got $55,000 at risk if I just had shares of stock. At Hurley Investments, we protect it with the long puts, but real risk for most people that buy a stock, the stock's going to lose half its value, or it can lose half its value. If you buy shares of Disney, you're probably holding a risk of a buy and hold or a momentum trader, or someone's trying to outguess Disney in the near future. On $110,000, you're probably running the risk of about $55,000. The most we could lose is $15,300. Disney could go out of business. This person could lose the whole $110,000. And the most we would lose is only $15,300. Comparatively speaking, it's like taking 11% of the risk of owning stock. And taking 11% of the risk of owning stock means we mitigated 89% of the downside risk of owning Disney stock. Let me say that one more time. When you have a stock replacement, a leap call, 500 shares will cost us like 15, although this is 600 shares. So let me do the math a little bit differently. Let's do 185 times 500 shares would be $92,000. But 92,500, so 92,500, actually it's 15,300 divided by 92,500. The risk is actually 16.5. So we are taking 16.5% of the risk of owning Disney if we were to own the shares. That's the risk in this leap call position, which means we're making up 85.5% of the downward risk. For everyone that's owning shares, you've got 100% risk in the stock, probably will only lose half its value. But if Disney was to go out of business, you'd lose $184 per share, $185 almost, right? For us, using the stock replacement strategy, we can only lose $15,300. There's another reason, though, why I chose the 5 contracts in this dollar amount. If Disney tanks, I'm going to say due to the economy, if it loses, if it tanks due to taxes, a COVID, outbreak, rules and regulations in certain states. There's all kinds of reasons, right? Let's take a quick look at a rational price Disney would go down to. And we're going to make a correlation. Pretty simple. I see it being somewhere in the 130, 125 range, on the low side at 120. There's a $60 risk to the downside on Disney. Let me make a correlation for you to see why I'm looking at the 200s. If Disney loses $60, all these prices shift. Our cost that we spent $30.60 for will probably drop down to $15.90. A $60 drop on Disney will lose us about $7,000 to $8,000 on our leap long haul position. They will, actually, I guess that's not right. It'll lose us $14. $14.70. A $60 drop on Disney will only lose in our position roughly half the value, but less than 25% of the drop, which means we'll have the opportunity to dollar cost average and to pick up more contracts at $15.90. My expectation is this might happen in the very near future. If you are planning on dollar cost averaging, you will spend more money, which is more money out of our $43,000 of profit. 5 more contracts. Doing the math, 1590 times 500 means I'm going to be spending another $7,950. 10 contracts, dollar cost averaged, equal a total cost, right? 15,300 plus 7,950. Doing the math here on my side, comes out to 23,250. When you divide that by the 10 contracts, we will have a new average cost basis of $23.25 per contract. Let me teach you a couple interesting rules on dollar cost averaging. Most people will say, I've got $43,000 of profit. So they will dump everything into it. And instead of doing 5 contracts, they'll do 15. They'll spend $45,000, which means what do you have to do if you need a dollar cost average? You need to dig back into your principal. You're putting your principal back at risk. You're no longer leveraging profits. You're leveraging principal again. Kevin, I heard options are risky. With all due respect, investing is risky. You've got to think forward. I think something that sets me apart is most people will spend that whole $43,000. They'll even go up to $45,000 and buy 15 contracts. I'm leveraging my profits. They never think ahead on, well, you know what? Stimulus package will boost it up, and then we'll probably have a big drop. Higher taxes, we probably have a second big drop. Dang it, you know what? We don't have the earnings that justify the growth in the stock market right now or the growth in companies right now. A third reason why we could have a big drop. If I run this to perfection, I'm going to use 23,000 of the 43,000. You will still have a $20,000 profit even if I'm wrong. If I'm 100% wrong, the thing turns on me, I'm still giving you a $20,000 profit on an initial investment of what? We're at 111, right? On 66,000, I'm still giving you a 33% profit, even if I'm wrong and Disney tanks and we don't make anything on these leap positions, even after I've dollar cost averaged them. You make money in the stock market by hedging your risk. You make exponential turns in the stock market by hedging your risk. Another great question. Kevin, what if you just bought protection, right? March, April, what if we went out to April or May? We just buy some insurance. Go at the money, slightly in the money. Go buy some insurance on this. Kevin, why don't you go ahead and spend $10.85 on buying insurance? Well, that insurance will cost me more than a third of my leap long call position. That insurance will cost me 2/3 of the expected price where I will dollar cost average, which means if I am wrong and all of a sudden Disney whips around and shoots higher and I lose that cost of insurance, I've just ruined your opportunity to leverage it. I now have to tack on another $10 of cost basis to the position, which is a third higher of the price. I now have to hope it goes even higher on your original shares. I've not lowered the cost basis, I've increased the cost basis. Well, Kevin, it can make you money on the way down, and it could, but it most likely will not make up enough that it justifies a third of the risk of the money invested in the position. This is April. What if we went out to May? Well, if you buy another month, I think it's going to look even worse, right? There it's $11.73, excuse me. It's $14.32. I'm now buying protection for 3 months on a 2-year, a 700-day position. I'm going to have protection for 92 days out of 701 days. And it's basically costing me half the position. The numbers don't add up. Why do I not buy insurance on leap positions? 1, because they're profits already. 2, because the risk to reward ratio is too out of whack. It's in our best interest to dollar cost average in this scenario versus buy insurance or protection on leaps, which we're using to leverage your profits. Last point, we're going to call it a day. If Disney gets to 300, or mathematically can make a price for it at 324.22, I think was my last calculation. What do we get? 10 contracts with the right to buy at 200. 324.22 minus 200 would equal an in the money, an intrinsic value, not extrinsic, intrinsic in the money value of $124.22 times our 10 contracts. And this is where I just love the numbers, right? 10 contracts times 100. 10 contracts times 100 is 1,000 times 124.22. It's equal to $124,220. If everything works the way that I had planned. Out of that 124,220, you do have to subtract your $23,250, which is equal to your net profit of $100,970. 109.70 divided by 23,250. You're looking at a 434% return on investment. Kevin, does this ever really happen in real life? Are we really seeing these kind of returns in real life? We see them all the time. On Apple, we've taken a lot of profits, we've rolled them up, but we still have two positions, 67-cent cost basis, and we're going to make $35. Where for $6.90, that leap call position is worth $76. Leap positions calls that we spent $5.91 for, worth $8.77. $4.49 worth $7. Because these are positions that are quote unquote pure profit, it's easier to let some of these run. Baidu, we have a ton of Baidu. We've added those shorts in here, but again, on a lot of Baidu positions, we have 29 leap call contracts for $63, worth $110. Disney, we have 150 calls, $11, worth $45. 180 calls, $30, worth $38. I had some more I'm going to show you. Target, I could probably show you. Starbucks, I could show you. These leap calls that are just, spent $10 worth $24. Target, 18 were worth $40. 21 were $34. Yes, it happens all the time. Take care, guys. I'll see you next week, and have a safe weekend. Bye-bye.